Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. With 1 hour left to go in the trading day, we are seeing all three majors in the red right now. The Dow down 113 points, the S&P 500 down 5, and the Nasdaq down 9. Weaker than expected factory orders, as well as some of that hawkish tone coming through from the Fed minutes weighing on stocks right now. Communication services and utilities really the only sectors in the green right now. We have seen some big moves to the upside for Treasury yields as well as commodity space. WTI crude now up roughly 3%. Well, new Fed minutes out today point to a divided central bank with officials struggling to balance a tight labor market and persistently high inflation. The minutes revealing the decision to pause rate hikes last month was far from unanimous. Here with the breakdown is Yahoo Finance's Jen Schomburger. Jen, what more did we learn today?
Hey there, Gigo. Yeah, that's right. While the decision last policy meeting to hold rates steady was seemingly unanimous, minutes from the Federal Reserve's policy meeting released with a 3-week lag show that there were some participants who favored raising rates by 25 basis points last meeting, citing a stronger than expected job market and economy, as well as inflation that remains stubbornly high. Now, nearly all members of the Fed felt additional rate hikes would be needed sometime this year. Still, many officials also noted that after rapidly increasing interest rates last year, it was appropriate to take a step back to really allow more time to monitor the impact of previous rate hikes on the economy and what that may mean for future rate hikes. Fed officials noted that the full effects of rate hikes had likely not yet been observed yet, though several officials highlighted the possibility that much of the effect of the past rate hikes may have already been realized. Now, several mentioned that credit conditions had not appeared to have tightened much beyond what would have been expected in response to the rate hikes already done last year, though some thought it was still too early to assess the effects of credit tightening from those bank failures earlier this year and still wanted more time to monitor those. Now, almost all officials felt that inflation was still well above the Fed's 2% target, and with a strong job market, that there was a risk that inflation could surprise to the upside or that inflation expectations could become unanchored, and that is shaping their policy outlook. Now, Fed Chair Powell said last week that rate hikes for consecutive meetings are not off the table when asked whether the Fed may move every other meeting. The market seemingly pricing in a rate hike for later this month, nearly 90% chance of a rate hike at the end of July. The latest inflation reading, though, showing no real progress on inflation, hence perhaps why the market's anticipating this hike and why Fed officials still standing so hawkish, even in these Fed minutes. Back to you.
And the attention shifts to the jobs market later this week as well. Jen Schomburger, as always, thanks so much for the breakdown.
Thanks.
Minutes from the latest Fed meeting signaling that policymakers are on track to raise rates in July. Here with more on what this means for the market for investors, we want to bring in Brian Jacobson, NX Wealth Management Chief Economist and Strategist. Brian, it's good to see you again. So when you take into account what we're learning here from these minutes, what traders are pricing in terms of the odds of another rate hike at the next meeting in July, what do you think this means for equities?
You know, I think that it means that the Fed, they really don't know what the data will be, so they don't know what they're going to do. Central banking is really a game of credibility. They're very concerned about inflation expectations and making sure that those stay anchored. And so they really want to strike this note of being very vigilant about inflation, saying that, hey, we are willing to hike more. Here at Annex, on our investment committee, we're not sure that they have a lot more hikes in front of them. And that just is simply because the data is showing that the broader economy is slowing and inflation is very gradually rolling over. It's doing it at a very glacial pace, but it should be good enough where maybe at best they need to hike one more time, and then they can just kind of call it quits for the balance of this year.
And Brian, you know, we know the Fed likes to say often it's not just about one data set, but we do have a big one coming up later this week with the jobs numbers coming out. You know, to what extent is that likely to affect the Fed's decision? And what do you think that number needs to be in order to at least get officials a little more comfortable with the fact that things are in fact pulling down on a consistent basis?
Yeah, and that's just it, on a consistent basis, right? They want to make it very clear that they are data dependent, but that doesn't mean data point dependent. It is really about the broader picture, the whole mosaic of data that they're looking at. And so it's really about getting 3 months in a row of seeing slowing down of the labor market, making sure that wages aren't growing too rapidly. And then next week with the inflation numbers to see whether or not we are on that trajectory towards eventually getting to 2%. So when it comes to this Friday's number, I think it's really about those wage numbers. It's not necessarily the headline number about how many payrolls expanded. It's not even necessarily the unemployment rate. It's just about, is that wage number year on year, month on month at a rate that is consistent with 2% inflation. So anything lower than 3.5% as far as year on year wage gains, I think the Federal Reserve will think that they still are on that path towards their ultimate goal of 2% inflation.
Brian, given the fact that inflation has been so sticky, it's still way too hot for what the Fed would like to see with their 2% inflation target. There has been more and more talk over the last several months that maybe that 2% target should be revised. Maybe it should be more like 3% at this point. Is that something that you think maybe should be on the table or something that the Fed could potentially consider at some point?
You know, that's a good question. And it really, that 2% number, it really was pulled out of thin air in a way. Really, New Zealand back in the 1990s is the one who kind of set 2% as being that type of inflation target that most developed market central banks have adopted. And there's really no good reason for it. You look at historically, the average is closer to 3%, but they've sort of painted themselves into a corner here. They set 2%. It's an arbitrary number. But if they were to try to move that or modify that now, it would be a very negative signal to the rest of the market as to their ability to actually get to any sort of target. They really shouldn't think about modifying the target until probably at least, say, 5 years down the road when they have gotten to 2%. We think they'll probably get to 2% over the course of the next 2 years, but they should first prove that they can hit that goal before they contemplate whether or not they should modify the goal.
Yeah, and it's sort of along the lines of what we heard from the heads of the major central banks last week when that discussion came up in Portugal. We've got two key pieces of data that was out Monday show that the U.S. manufacturing sector is in a slump. Demand remains weak. Production is slowing due to lack of work. How long do you expect this trend to last? And is this a sign of what we're likely to see past the summer?
Yeah, unfortunately, manufacturing is stuck in the mud. And really, we're going to be getting the ISM services number tomorrow. We have to see whether or not the service sector strength continues. But we're not expecting that manufacturing is going to stage any sort of rally between now and the rest of the summer. It might be an early 2024 story as far as the manufacturing recovery. Now, markets are forward-looking, and so they're going to try to anticipate when the activity is going to improve. Unfortunately, it does look like the market is expecting that this is perhaps the end of the earnings recession. Earnings for the S&P 500 peaked back at the end of 2022, and on a quarterly basis, quarter on quarter, they've been declining. Analysts seem to be expecting one more quarter of a decline and then the beginning of a rebound. That might be a little premature here, which is one of the reasons why we're very focused on trying to participate in the markets, but having the emphasis more on quality equities as opposed to just going sort of with the go-go growth story.
Well, Brian, I guess what do you think is the more realistic time frame then of that, just in terms of when we will see some improvement on earnings?
Yeah, we're expecting that we're going to see the improvement on earnings mainly towards the end of 2023 here, perhaps early 2024. According to the FOMC minutes that were released, the staff economists are expecting that we're going to see a recession, two negative GDP growth rates in the fourth quarter and then the first quarter of 2024. Earnings oftentimes will bottom during those recessions. And so if the market moves about 6 months ahead of that, we could be positioning ourselves for a decent, sustainable recovery for the markets, maybe more towards the fall period, let's say around October or November. But of course, it all depends on how the data rolls in, right? If the Fed is right with the projection of a recession in the fourth quarter, we think that's a pretty reasonable estimate that right now there's a few more rain clouds that are beginning to form over the markets.
So what are some of the investing themes you're sticking to in the face of some of those clouds forming?
Yeah, so we want to participate because there is some decent value, especially outside of the biggest tech names that are out there that have been driving the market higher year to date so far. We do like some of the smaller cap names, some of the international names as well in the equity markets, but it's really more about this theme of focusing on quality. And for us, quality is kind of in the eye of the beholder. To us, it's really defined based upon whether or not they're able to have resilient margins relative to their peers. So it doesn't really matter which sector they're in. Is it a company that actually is able to ride through what could be a challenging environment by maintaining their margins? Have they already done the cost cutting necessary in order to ride through any type of perhaps mild recession that we might encounter? And a lot of those names are more in the smaller cap, the mid cap names, and then also outside of the United States.
Brian, what about fixed income, the bond market? Where are you seeing the most opportunity there as investors are trying to balance or add some sort of balance to their portfolios?
Yeah, but here at Annex, when we're looking at it as far as the fixed income profile, it is somewhat of a barbell approach. If you think about the cash that you can hold, getting a decent amount, but eventually cash rates will begin to fall once it gets to the point where the Federal Reserve is going to start cutting. That might not be until the end of 2023, maybe early 2024. So you can kind of ride in cash. You can make hay while the sun is shining there. But then as far as to get a little bit more income, we like the higher quality, high yield names, not necessarily scraping the bottom of the barrel when it comes to credit quality. It's more the creme de la junk. So the things that are the higher quality where it has a short duration, low likelihood of default. And that's how we're trying to sort of balance the safety when it comes to cash, but a little bit more income when it comes to getting that high yield exposure.
All right, Brian Jacobson, NX Wealth Management Chief Economist and Strategist. Thanks so much for your time.
Thank you.
We are just getting started here on Yahoo Finance Live. Coming up, student loan borrowers will start paying them back this fall thanks to the Supreme Court ruling. More on what it means for the economy and the housing market on the other side. Plus, shares of chip makers are down today after China restricted exports of key metals to manufacture semiconductors. We break that down later in the hour. And EV shares riding higher today following GM's sales report and some solid delivery numbers out of Tesla and Rivian. That and much more when Yahoo Finance returns.
I believe the court's decision to strike down my student debt relief program was a mistake, was wrong. I'm not going to stop fighting to deliver borrowers what they need. Today's decision has closed one path. Now we're going to pursue another. I'm never going to stop fighting for you. We'll use every tool at our disposal to get you the student debt relief you need and reach your dreams.
That was President Biden on Friday announcing new actions on student loans after the Supreme Court blocked the administration's loan forgiveness program that would have delivered up to $20,000 in relief for individual borrowers. Well, meanwhile, Congress ended the 3-year pandemic pause on student loan payments, so borrowers will start paying back their loans this fall. Now, here with what this means for the economy and the housing market, I want to bring in Lou Chen, Moody's Analytics senior economist, and Thomas Simons, Jefferies U.S. economist. Great to see you both. Lou, let me start with you just in terms of the economic implications of this. How do you see this impacting the consumer and more broadly, the economy?
First of all, thank you for having me. This means starting September, October this year, average student loan borrower will have to start paying on average $275 every month out of their discretionary budgets on student loan payment. And this is adding additional pressure on the already unaffordable housing market for the US by and large. So we look at the differential between the Class A versus Class B and C rental market and identified across 79 majority of the US metropolitan areas, trading down from Class A to B and C units would create potential surplus even after paying that additional $275 every single month.
Thomas, that number that Lou just pointed to, $275 a month, roughly, potentially up to $300. I mean, it really does depend on what an individual's financial situation is. But when you all add it up, what's the impact to the broader economy?
Yes, you make a very good point. And this is something, I'm sorry.
Oh, Thomas, go ahead.
Go ahead.
Okay, yeah, sorry. So this has been one of our major themes for the economy and our outlook for this whole year so far. And we've done a lot of work in trying to figure out exactly what the impact is going to be. And as you point out, the loan borrower base is extremely sort of heterogeneous, right? There's not that many, common themes that you can paint across, broad swaths. So some people, their payments are substantial because they have not only, a big load from undergraduate debt, but also graduate debt. They may have multiple children that they're paying tuition for as well. And then there's other people who are on income-driven repayment plans whose, nominal payment is a very substantial number, but it's not what they're actually paying because they're only actually having to pay a percentage of their income. So taking it all together, our estimate ended up being slightly higher, but I wouldn't put, a tremendous amount of confidence in that. The way I look at it is it's pretty similar to what happened in 2013 with the fiscal cliff. And if you recall back then, essentially the net effect of that was a 1% increase in the payroll tax. And, 1% increase in taxes equates obviously to a 1% decline in disposable income. And the aggregate impact is very similar here going forward. The difference being that there's only 40 to 45 million student loan borrowers, and that payroll tax affected well over 100 million people. So you're talking about a smaller group that's hit significantly harder and a large group that, can essentially continue on without much of an impact.
And Lou, with that in mind, and you pointed to this very quickly, but digging down a little bit deeper into it, just in terms of what this will do to the inventory shortage, an issue that we're already facing when it comes to housing, what it's going to do to exacerbate some of the other structural challenges that are already taking place in the housing market. What exactly does that potentially look like over the next 6 to 12 months?
Absolutely. So when we look at the entire housing ecosystem, so the United States has been facing this housing shortage for the past decade or even longer. So at the beginning of the century, if we look at the inventory of Class B and C rental units, that's roughly account 2/3 of the total rental landscape. And coming down to the first quarter of the second quarter 2023, that ratio of more affordable Class B and C units is only account to less than half of the total rental inventory. And overall, if we look at the housing shortage, a lot of that shortage exists in that structural imbalance, meaning for the renter on the margin. So if they couldn't get into this very competitive Class B and C market, then they have no option but to enter into the more pricey, cost-burdening Class A rental units. And that is exacerbating this housing shortage and affordability crisis. So by the end of 2022, according to our tracking, on average, the US renter is paying 30% of their monthly income on renting an average priced rental unit. And that 30% is classified as the rent burdening threshold. And that's not accounting for utility. That's not accounting for other discretionary spending. So with that, keeping that in mind, having to spend additional $275 is actually creating less financial buffer, which they could be enjoying on the service spending, on the goods spending, on the retail, and other forms of spending in their life.
Yeah, so let's pick up on that point, Thomas. Lou's focused specifically on the real estate sector, but I know you're looking more broadly at the economy too. I mean, what are some other sectors that you think could get particularly hit? Retailers, for example, have been warning about the potential hit to discretionary spending.
Yes, I mean, it is pretty wide ranging, and I think that's because there are some significant knock-on effects that maybe we don't just consider when we look at just the sort of what the actual number is in terms of the payment. We're talking about reversing an impact on the economy that has been a continual stimulus for the last 3 years. Like each month that people haven't been having to pay their student loans, there's been extra money that's been floating around in the economy as a consequence. Another thing to keep in mind is that without having to make these payments, people maybe looked at their budgets in a different way, thought about their overall debt burden in a different way, and took on debt in other areas that maybe they probably wouldn't have had they had to continue paying their student loans, right? So a good example of this is in autos, where we hear essentially every day about more and more kind of troubling statistics about the bubble that's formed in the auto lending market. Very high monthly payments, loan to value ratios over 100% for depreciating assets. And of course, it obviously doesn't help with people's ability to pay for their housing, whether that's in the for sale or rental market either. So I think that, combined with anything that is really leveraged to debt, I think is at threat. But the other issue is I think that, just in terms of discretionary spending, people feel like they had a promise broken to them, right? So this can have a pretty significant psychological impact just in terms of, how people view, essentially what they can take for, at face value from the government in terms of, what policies are being discussed. And also just generally kind of the sense that you can never get ahead in an environment where inflation has been running at multi-generational highs as well.
So Thomas, then with that taken into consideration, I guess, how does this then factor into the probability of a recession and what we could see the economy look like here, at least in the short term? Because there has been so much debate leading up to this, ahead of this decision, obviously, about whether or not we were going to see a recession, lots of calls that we would have seen one by now. But largely speaking, we are in an okay place. Is that all about to change because of this?
Our view is, yes, essentially we're kind of at a plateau in the economy, right? Where growth rate, slowed down pretty significantly in Q1, the revisions from last week notwithstanding. But Q2 is shaping up to be pretty poor, in my opinion. And with Q3 and Q4, more Q4 than Q3, I suppose. But, with the end of the year clearly going to be burdened by these student loan payments, I am concerned that we're probably going to go into a recession before the end of this year, maybe the end of Q3, beginning of Q4. Now, that doesn't vary terribly from where we were before we started to factor in the student loan repayments. We had always been kind of focusing on household cash balances and where sort of we sit with excess savings that was accumulated during the pandemic. It was as high as $2.2 trillion in the middle of 2021. Since the end of 2022, consumers have been spending down that savings. Savings rate bottomed in June of last year, and it's actually been rising since then. So you no longer have this tailwind from people spending down their savings. It looks like they're actually trying to repair their balance sheets instead. And that's good for them, but it's bad for the economy in the short term.
Finally, Lou, you were talking about the potential shock that could be coming for the real estate sector. We have seen in the past some of these shocks, particularly around graduates, have a lasting impact. And I'm wondering, when you're thinking about those students who haven't had to pay down for several years now, I mean, if you're looking specifically at the real estate sector, How long until we start to see things stabilize again?
So it takes quite some time for the real estate market to stabilize, and it might take even longer for us to start seeing the marginal impact. So during the past recessionary period or economic downturn, what we've seen when the trading down option has been exercised or more evident influence has been shedding on other commercial real estate sectors such as retail, it usually takes months up to years until some of the effects started to manifest it, especially considering the lease term, and usually it's longer than a year also. So we started seeing some of the effects started to trickle down towards the mid or end of the recessionary period. And it takes longer because some of the construction will take longer to complete, and some of the leasing rollover will take up to a year or even longer to start reversing. So we might even see longer time for that potential damage to be repaired after the recessionary or economic downturn.
Lou Chen with Moody's Analytics and Thomas Simmons from Jefferies. Appreciate both of you providing the context. Thanks so much.
Thank you.
Stocks slipping today as traders eyeing headwinds for the global economy and also digesting the Fed minutes from the last policy meeting. Yahoo Finance's Jared Blickery here with a closer look at some of the losses that we're seeing, but also the movement in the 10-year today.
Yes, I think the 10-year is very telling about what the direction is perceived with respect to the Fed, and that is higher for longer. So let's see, 10-year is up 9 basis points today to 3.95%. On a 3-month basis, you can see easily the highest level we've seen in many months. Here's the year to date, and I'll put a line chart so it's a little bit easier to see. Actually, let me put a 1-year chart, and I can draw a trend line down. This matches rather precisely on the candlestick chart, so a definite break to the upside here. Now, the interesting thing is tech stocks typically do not like higher rates, and especially on the 10-year, the longer rates. Nevertheless, over a longer period of time, we've seen tech stocks kind of decouple from bonds. So let me show you what I've been noticing here. First, we have the New York FANG index, and we can guess what that is. It has a lot of heavy weighting towards some of those heavier growthy names versus bonds. And for bonds, I use TLT, and that's inverse to yield. So when I said tech stocks don't like high yields, well, guess what? We are seeing higher yields now because we see a lower TLT, but what has happened? New York FANG and those growthy stocks have exploded to the upside here. Now, let's check out another correlation. This is stocks versus copper. So I have the S&P 500 ETF versus copper, and Dr. Copper is kind of a referendum of where the economy is. What I want to point out is that copper, this blue line right here, cyan, has been trending down while stocks have been going up. This too is a divergence. Usually there's a resulting convergence, and so somebody's going to have to either catch down or catch up here. Finally, want to show you another correlation, tech versus home builders. No decoupling here. Just an interesting thing I happened to notice when I was going through a bunch of these. This is a very closely correlated pairs trade, except there's no. In a pairs trade, you usually have one long and one short. Here, you just have 2 longs. So let me get back to the main market, and we can plot some heat maps and show you what's going on. One of my central theses coming out of the first half of the year is that strength, like we saw in the first half, usually begets more strength in the second half. That does not preclude some painful rotations. You might not even see it in the passive indexes like the S&P 500, but under the hood, we've seen a lot of painful rotations over the last few years, not precluding that. Here's the sector action for today. Utilities, that is an interest rate play. Interesting to see that. That's up 1.5, followed by real estate, also interest rate play. Communication services and consumer discretionary and healthcare, all in the green there. So going to be an interesting second half to the year. I promise you that. That's all I can promise.
It certainly will be. We'll see who's leading the way in the second half. All right, Jared, thanks. Well, coming up, escalating tensions between China and the United States as China retaliates in the ongoing chip war. More on that when Yahoo Finance returns.
Well, shares of chip makers are down broadly today after China restricted the exports of metals that are critical to manufacturing semiconductors. The new rules specifically target gallium and germanium, and it comes months after the U.S. imposed sweeping restrictions, all but banning shipments of advanced chips to China. And of course, it comes as Treasury Secretary Janet Yellen prepares to visit Beijing. Here to discuss further, let's bring in Charles Kupchan, Professor of International Affairs at Georgetown University and Senior Fellow at the Council on Foreign Relations. Always good to have you on the show. Talk to me about the timing of all of this, these restrictions being announced just days before Treasury Secretary Janet Yellen is set to make the trip.
Well, the U.S. and China are in a bit of a dance here, where the relationship was in the freezer basically since the U.S. shoot down of the Chinese balloon that drifted across the United States. Blinken, Secretary of State, his trip to Beijing was canceled. Finally, it was put back on the schedule. He went a couple of weeks ago. Now Janet Yellen is going in an attempt to restart the dialogue. But the relationship is in a very difficult place right now. And just in advance of this trip, we're seeing, number one, the Chinese say export controls on these metals that you use in advanced chips. The United States, we're now hearing, is about to restrict the access of Chinese companies to cloud computing as a potential backdoor to getting advanced access to AI and these kinds of things. So she's going at a time when the relationship is fraught. I think there's a willingness on both sides to try to push the conversation as a positive direction, but it's going to be real. It's going to be an uphill battle.
Specifically on these critical metals, I mean, we have seen China do this before around rare earth minerals many, many years ago. How critical are these metals that have been mentioned, and what's your assessment of the impact this is likely to have, at least within the chip making space as well as the solar space?
Well, I think that the Chinese have seen the U.S. announcement about restricting access to high-end chips and chip-making machines as a sign that the United States wants to contain China and prevent its rise, prevent it from economic growth, keep it 2-3 steps behind the United States. And they see this as, in many respects, not an act of war, but a real sign that the U.S.-China relationship is headed in a very negative direction. And as a consequence, they're trying to begin to push back. They're saying, if you restrict our access to high-end chips, we're going to restrict the access of the metals that you need to make those chips. And I think what we're seeing here is the two sides feeling each other out about how far this tit-for-tat game is going to go. The National Security Advisor, Jake Sullivan, has said small yard, high fence. That is to say, we're going to restrict a relatively small number of technologies, but we're going to make sure the Chinese can't get them. The big question right now is it going to turn into big field high fence? Is there going to be a snowballing effect where the U.S. and the Chinese economies begin to effectively decouple? We're not there yet, but that in some ways is the $6 million question. And the Chinese announcement about restricting the export of these metals, I think, is a sign that we are heading in that direction.
You highlighted a number of issues that are on the table in the Treasury Secretary's visit to Beijing. Do these latest restrictions that have been announced from China, does that give Beijing a little more leverage in these talks?
Well, I think both sides are trying to set the table here. I don't think it's an accident that the Wall Street Journal reported that in this new announcement, this new rule that's going to be coming out later this year from the Biden administration, that it will include potentially restrictions on access to cloud computing. The Chinese, I don't think, accidentally announced that they're going to restrict the export of these critical metals. In some ways, both sides are jockeying. They are trying to get the upper hand in this conversation. And I think, we know from history that you got to get the geopolitics right if you're going to get the economics right? You can't solve U.S.-China tension by Janet Yellen making a breakthrough here or breakthrough there on trade. But I do think what we're seeing here is that two sides begin to engage in a conversation that's aimed at trying to put a floor beneath the tension, trying to prevent the further slide in U.S.-China relations. Right now, it's simply too soon to tell. Both sides are taking tough measures against the other, not making concessions and showing signs of moving toward more cooperation.
Where do you think this leaves other countries that are U.S. allies and big players, particularly in the chip space? I mean, South Korea, for example, has really shown that they're a little uneasy in having to take sides in either direction.
Well, so far the United States has gotten the Netherlands and Japan to cooperate on this chip restriction. I think the bigger question is Europe, is South Korea, is Japan, are these other countries that have major trade relationships with China going to agree to go down the road of some significant measure of decoupling with China? And at this point, I don't think we know the answer to that. I do think that the Europeans in particular are uncomfortable with the prospect of an escalation in a trade war. Germany's main trading partner is China. Its car companies have big business in China. And so I think right now the sides are feeling each other out, and the United States is trying to pull Europe in its direction. But so too are the Chinese worried about the erosion of their relationship with Europe. And that relationship has taken a serious southward turn because of the war in Ukraine and China's backing of Russia in that war. Right now, I think the Chinese are on a bit of a charm offensive with Europe, and not just with Europe. They're trying to get more involved in Middle East diplomacy, brokering a deal for rapprochement between Iran and Saudi Arabia. So I think that the Chinese strategy here is to try to isolate the United States, keep good relationships with the global South, with the Europeans in particular, at a time when the relationship with the U.S. seems to be going in a more difficult direction.
And finally, Charles, so many of these restrictions, or at least verbal warnings, have been around the tech space. We talked about concerns around data sharing, cloud computing, AI, semiconductors, and materials there. Does this go beyond that? Is there a risk of that, or is this largely contained to tech because of the competition and then the ramifications of tech being transferred in either direction?
Yeah, I mean, it's a great question. And I think for now, this is, as Jake Sullivan puts it, a small field. It's restricted to high-end technology. It's restricted to technologies that if the Chinese military got its hands on it, it could put it in a position to become a more serious competitor of the United States in a geopolitical sense. We know that during the Cold War, the United States and the Soviet Union had effectively no commercial relationship, a fracture in the global economy. We now live in a much more interdependent world in which the US, Europe, many countries in the global South are deeply integrated into the Chinese economy, going back to a global fracture in which you don't just decouple in a minimal way, but you deglobalize. That would wreak havoc on the international economy. And that's why I think everybody's watching carefully to see whether this tit for tat that we see between the US and China now stays restricted in the realm of AI and high-end semiconductors, or begins to broaden to other sectors. That, I think, is the key question. We won't know the answer because right now both sides are feeling each other out.
Okay, well, we'll all be watching for any developments coming out of the Treasury Secretary's visit there. Charles Kupchan, Georgetown University professor and member of Council on Foreign Relations, thanks so much for joining us today.
My pleasure.
Well, coming up, shares of Netflix rising today on the back of a big price target hike coming from Goldman Sachs. We're going to dive into what drove the upgrade on the other side. We'll be right back.
The question was, can the Biden administration unilaterally, or really any administration, forgive federal student loan debt under the HEROES Act based on an emergency, national emergency, in this case, COVID-19 being the national emergency there. And the question was, could they do that without approval from Congress? And this court here saying no in a 6-3 decision that goes back into repayment in September. So those payments are going to have to be made, or other arrangements to apply for other forgiveness plans. But this particular debt relief is off the table. There has been so much talk about the potential impact on inflation, that this could compound problems here in the United States with prices being so high, that now these borrowers are going to have to go deeper into their pockets and grab some money for student loans. And they've had this reprieve for over 2 years now.
Even the folks that we started with a plan when this was first announced, we obviously have been revisiting it in recent weeks in expectation of this announcement coming out. And now what we're in the process of doing is relooking at their situation, putting a plan together, looking at their budget to make sure that they're going to have sufficient cash flow to pay for these payments as they restart. The bottom line is, either way, these payments are coming and you have to be prepared to start paying them or pay off the debt.
This ruling by the Supreme Court is not a surprise. Clearly, the White House was prepared for it. I think this is a messaging win for Biden, to tell you the truth, because he can say to voters, elect me again in 2024, make sure Democrats retake control of Congress so we can pass this legislation so that the Supreme Court can't undo it again.
Netflix shares higher today after the streaming giant got an upgrade at Goldman Sachs from sell to neutral. Yahoo Finance's Josh Schaefer joining us now with more on that move. And Josh, they like what they're seeing here from the password crackdown, it looks like.
Yeah, Shauna, so it's the password crackdown and sort of how that combines with the ad tier, right? So this is one of several upgrades we've seen for Netflix in the last several weeks. A lot of price target boosts as well, as the stock's been up significantly over the last year. And really what Eric Sheridan from Goldman Sachs laid out today in that note when he upgraded the stock from sell to neutral, you can see the price target there up from 230 to 400. He said that Netflix's management has executed its password sharing initiatives in excess of our prior assumptions, essentially saying they've clamped down on these password sharing users more than they initially thought they could. And that's been impressive to Goldman. And overall, what that creates is more users that are gonna have to go out and get their own account. Now, when Goldman estimates what that's going to be worth for Netflix, it's interesting when you think about the overall revenue. So Netflix did about $36 billion in 2022. Goldman sees that coming up to about $49 billion annually in 2025, and that's from people either signing up for a shared account at $7.99 or becoming an ad tier member, which Goldman says per month brings in Netflix about $15 in revenue. So turning that 100 million people that were sharing passwords into paying Netflix users is the key, Goldman says, and they think that's going to turn out to go pretty well for Netflix in the long term based on what they're seeing right now in the early days.
Josh, what about some other data that Goldman's pointing to when it relates to app demand?
Yeah, Kiko. So it's been interesting to just look at how the app downloads have gone back up into positive growth year over year. Remember, a big talk about Netflix in 2020 over the pandemic was how much year over year app downloads were growing. And then, of course, that meant subs were growing, right? Well, now since we've seen this password crackdown, you can see on your screen now in 2023, app downloads have gone over 0%, so growing year over year for the first time since 2023, meaning people are signing on their Netflix account. They're realizing they can't share their password anymore with whoever they were sharing it with, and they're actually downloading the app themselves on another device and potentially signing up for an account. Now, it's still to be seen how many of those app downloads lead to more subscriptions, right? And sort of what tier they are buying into. But we'll probably find out a little bit more about that when Netflix reports earnings in 2 weeks. But again, just another bullish sign from the street headed into that earnings report.
Yeah, recently got kicked off myself, Josh, after using my parents' password for so long. Did you get
a new account, Akiko?
I do have the app. I do have the app, and that's how I'm watching it now. So I'm one of those. Josh Schaefer, as always, thanks so much for that.
July 4th weekend has been a record for travel, with TSA screening more than 2.8 million passengers on Friday alone. But many of those flyers, they've been caught up in cancellations and delays. According to FlightAware, Over 3,800 flights have been scrubbed. Nearly 45,000 have been delayed. Now, for more on the recent travel chaos, we want to bring in Anthony Roman, a former FAA commercial pilot and also the founder of Roman and Associates investigative firm. Anthony, it's good to see you here. So there's certainly a lot of finger pointing going on after what we've seen play out over the last week and a half or so. We have Transportation Secretary Pete Buttigieg. He's pointing fingers at the airlines. The airlines are blaming the FAA. I'm curious just to get your perspective as to why we have seen what we have seen, the chaos transpire over the last week or so.
It's a conglomerate of problems that have come together in an unholy alliance that have created this. And it's all forged by the pandemic and the steep decline in passenger flights during that period of time. It resulted in massive layoffs and early retirements for pilots, for flight attendants, for baggage handlers. Infrastructure investments dropped. So the computer software, the computer hardware, the FAA air traffic control system, was slow to modernize to current standards. And there are fewer controllers. In addition to that, the airport infrastructure was not receiving many investments during the pandemic, and all of that is surging now. And you have all of the problems trying to be solved at once. It's going to take several years to do this.
Anthony, and that's come at a time when we have seen incredible travel demand despite some of these inflated prices, with Americans showing they're still willing to shell out that money. So what's the breaking point, you think?
Well, I think we're close to the breaking point, but the airlines and the FAA have started rapid initiatives to begin solving the problem. And I think over the next year or two, we're going to see progressive improvements in the situation. For example, the FAA has now started to hire many more controllers, accelerate their training, put ground radar at the most important airports so that they can monitor the taxiing of aircraft. The airlines have associated themselves with accelerated flight training programs, which have proved to be very, very safe to get pilots into the pipeline much sooner. They're also petitioning the FAA to consider extending the pilot mandatory retirement age to 67, and that would help immensely. You have many, many baby boomer pilots who are reaching that age. I got to tell you, if that retirement segment goes into effect and it's still mandated that they have to retire at 65, the problems will increase.
Anthony, what about the backlash, though? And what we've seen play out over the last week or so pales in comparison to the number of flights that Southwest canceled right around the holidays. But United this time around was arguably the most affected. They canceled over 3,000 flights. What does the backlash look like from a consumer perspective, and what these airlines need to do to win back those flyers that they might have lost?
Well, the consumers are angry, and rightfully so. Some airlines have done a better job at infrastructure investment than others. Delta, one of those examples, one of the largest, if not the largest airline in the world. And that is the foundation of the problem. Now, I understand that United has offered all passengers who suffered significant delays and or cancellations 30,000 miles in flight points. So we hope that this is a salve that soothes the wound and keeps passengers coming back to United. It is a very good airline.
Finally, Anthony, you talked about two key shortages that we're seeing, one with pilots, something that's been ongoing, and then the other with air traffic controllers. What does that training entail for air traffic controllers? Is it a recruitment issue, or is it about having to get any newer ones up to speed? And what does that timeline look like? How long until we clear the backlog?
I think there's sufficient recruiting success for this problem to be managed over the course of a year or two. It takes a long time for air traffic controllers to gain the knowledge and then the experience to manage the lives of everyone flying above and the risk of any errors that are fatal for residents on the ground. It's a very serious business, and the FAA takes it as a very serious business. But that'll be a year or two before we start seeing improvement. But it's going to be on a graduated scale. We'll see small improvements over time on a continuous basis. The pilot situation is very, very similar. If the FAA extends the retirement age to 67, I think we'll see the improvement faster. If it remains at 65, then it's going to take a bit longer to start seeing that situation improve. The concerns we do have is young, quickly trained, but well-trained pilots in the cockpit that don't have the kind of experience they would have in the elongated training programs of the past. Now, that's something that they'll be learning while they're in the cockpit with a senior airman, the captain, and that seems to be working out well. However, there have been some taxi incursions, and several of them in a very short period of time. The question is that secondary to the accelerated flight training and the shorter period of time with well-trained young pilots without a lot of experience? That's a big question mark. Time will tell.
Yeah, either way, it sounds like still a choppier travel experience, at least in the immediate future. Anthony Roman, good to talk to you today. Appreciate the time.
Thank you.
Coming up, we are getting set for the closing bell on Wall Street. More market coverage on the other side when Yahoo Finance returns.
And that's the closing bell on Wall Street. All three of the major averages closing to the downside. The Dow off just around 130 points. Nasdaq off about 0.2%. Let's take a look at some of the individual movers of the day. A couple of tickers that we're keeping an eye on. First up, Meta, the stock rising ahead of the expected launch of its Twitter competitor Threads. Now, it goes live on Thursday, focusing on real-time conversations and its connection here to Instagram. Akiko, I don't know whether or not this is going to be a win here for Instagram, for Meta. We know they have copied some ideas in the past. Some have worked out in their favor. Some have not exactly been a hit on their platforms. They're doing it at a smart time, given Twitter's troubles. but I don't know how much demand there is for a product like this.
Yeah, you know that Snap and TikTok are looking at this saying, I don't know, they kind of did that to our features before. But in terms of timing, this is going to be an interesting one, because when you think about it, since Elon Musk took over Twitter, advertisers essentially said, we're not really comfortable necessarily putting our ads up next to some of the content that's on the site. We have seen the likes of Blue Sky and Mastodon try to take some of those users away. They haven't necessarily found a lot of success. But if you're talking about Instagram, we're talking roughly 2 billion users. And you've got to imagine advertisers are saying, look, that's a name, that's a platform we feel a little more comfortable putting ads up against. So I'm curious whether the users follow, but the big launch coming up tomorrow, and we'll all be watching there. Another trending ticker we're watching today is Plug Power, the stock jumping on an upbeat note from Citigroup. They're initiating coverage on the stock with a buy rating and a $13 price target. The analyst says Plug Power is best positioned in this space and has a path to profitability. And we're talking specifically about green hydrogen, which is the play for Plug Power. But, if you look at the stock, Shauna, it has been a rough ride for those shareholders. When you think about the declines that we have seen, Citigroup specifically saying they think that Plug has the partnerships in place, the sufficient liquidity, the diversified assets. They do have partnerships with the likes of Walmart, but it'll be interesting to see how mainstream this can get, because it is a very costly endeavor if we're talking about hydrogen.
Yeah, and I think that's a big question, just in terms that they pointed to the strength of their balance sheet, that really giving Plug Power an edge over some of the competitors out there. But what demand is going to look like for hydrogen going forward, that, of course, is a big question mark when we're trying to gauge just what exactly the size of this market could potentially look like in years to come. You mentioned the cost, and that's so important to this conversation, given how expensive this potentially could be when it comes to Plug Power. At least Citi's argument here is saying that some of the government incentives, also better infrastructure, should help support some of the, better positioning and pricing that we could see going forward. But I think if you're buying into this now, you got to be ready for a bumpy ride, at least in the short term, until we start seeing a better path to what exactly that demand's going to look like. All right, let's also take a look at Coinbase moving on an analyst move, this time, though, on a downgrade. Piper Sandler cutting the stock to neutral from overweight, saying that there is too much uncertainty for the company, especially in the wake of the SEC lawsuit. Lots of questions just about what regulation is going to look like more broadly speaking when it comes to crypto. Coinbase today, Akiko, off just about 2%, but certainly has been a massive winner since the start of the year.
Yeah, I mean, you have to think that the narrative around Coinbase hasn't necessarily shifted in terms of the uncertainty around regulation. Yes, we have seen the recent actions coming from the SEC, but we've still been looking to Congress to see if there's a new bill that's going to be introduced around regulatory action in the crypto space. So, similarly to what we were saying with somebody like Plug Power around Coinbase, you got to kind of stomach some of the bumpy rides there, because there's still a lot of uncertainty around there.
Certainly is. All right, let's also take a look at GM ending the trading day higher after the automaker reported second quarter sales numbers earlier. We're looking at gains of just about 1%, an increase of 18%. Supermania is taking a closer look at this. And Praz, when you take into account some of the demand out there, we were wondering whether or not consumers were going to pull back on some of their spending. It looks like the appetite for new cars is still there.
Yeah, strong sales there for Q2. The demand is sort of coming back there for new cars, even at these elevated prices and higher rates, right? So we see here that number is a 19% jump there year over year, powered by GMC trucks, Chevrolet cars, and also Cadillac, luxury premium brand Cadillac doing well here. GM also sees a 16 million unit SAAR, or seasonally adjusted annual rate, for the year. So that's bigger than before, much higher than before, kind of reflecting the trend across other companies like we mentioned. Toyota and Honda also came out with sales today. They were pretty strong too. So big here for GM. But also, I want to touch on EV sales. EV sales up 120% from a year ago. That's the Bolt, that's the Lyriq. A few Hummer EV sales here and there, but that's good news for GM as they kind of have a big year coming up with the Equinox EV, the new Silverado coming out this year EV. So the big year ahead for them for EVs in particular.
Praz, we also saw EV makers Tesla and Rivian both surging on Q2 deliveries. What drove some of the gains there?
Tesla, global story here. We saw China numbers yesterday, very strong there for Tesla, but around 466,000 deliveries in Q2, easily topping estimates there. price cuts. There's massive price cuts from in the U.S. and, of course, abroad, as well as the Tesla Model 3 getting full EV credit status here in the U.S. help gin up sales there. The question is, can that continue going forward? I also want to touch on Rivian, too. They also beat both on the production and delivery numbers there, and also reiterated their 50,000 annual production guidance goal for the company. And as well, one other thing for Rivian, they're going to start delivering 300 or so electric EDV delivery trucks for Amazon to Germany later this year.
Yeah, we're looking at Rivian shares closing up just about 4% today, so adding to some of the gains we saw earlier this week. All right, Pras, thanks. Well, coming up, Americans are spreading out physically and economically and heading south. We're talking the reasons behind why the Northeast and Midwest regions have seen decreases in their state's share of national GDP. Stay tuned.
A strike of UPS drivers is looming after labor negotiations collapsed overnight. Let's bring in Alexis Keenan, who's following the details for us. And Alexis, how big of a scale are we talking about in terms of a potential strike?
So this potential agreement, Akiko, would cover approximately 330,000 UPS workers. So a massive number of employees there and other workers. So this battle is between the Teamsters union that represents UPS workers and UPS management. They're blaming each other, saying it's the other side that's frustrating negotiations to renegotiate the collective bargaining agreement that that pertains to these workers. Now, the current agreement covering that 330,000 workers includes package handlers, and it's set to expire at the end of this month on July 31st. Now, the union workers, they want higher wages, they want more full-time jobs at the company, they also want better working conditions, and they've already authorized a strike to take place if talks completely break down. Now, there's no further negotiations scheduled. The July 5th deadline had been set by Teamsters President Sean O'Brien, so that the workers would have time to look at the agreement that's being put in front of them, or that will be put in front of them, and also time to vote. So UPS, for their part, they say that these trade negotiations are going to threaten the U.S. economy if this agreement is not reached, though it's unclear really how much a strike would disrupt U.S. supply chains, given that there are competitors, of course, there to potentially pick up the slack should an agreement not be able to be reached. Now, take a look at the numbers here. For 2022, UPS held the top spot in both revenue as well as market share for parcel delivery. They held 37% of that market over FedEx's 33%, followed by USPS with 16% market share, as well as Amazon Logistics with that 12% market share. In separate statements that kind of don't add up to the truth here, UPS on one hand saying that they did not walk away from the negotiating table, and that despite the company's historic pay proposals that were put in front of the Teamsters and their management there, that they're refusing to negotiate. On the other hand, you have the union saying that it's UPS that walked away from the table after marathon negotiations that went on for 8 weeks, and that the offer that they were presenting didn't address the workers' needs. It's untold how much the tight labor market will give an edge perhaps to the union in these negotiations, but right now, no further negotiations on the table.
Alexis Keenan, thanks so much for that.
The U.S. is seeing a shift in economic hotspots over the last 2 years that are pointing south. Here with the details, Yahoo Finance senior columnist Rick Newman. And Rick, we talk about a lot of people that have left the Northeast, did leave the Northeast during the pandemic. They headed south. So what are we seeing just in terms of the economic landscape and what that looks like now that not as many people are living up north?
Yeah, then I guess the country's getting wobbly. It's getting bottom heavy with all these people who are leaving the Northeast and the Midwest for the South. I mean, not a new trend, obviously, but Bloomberg looked at some of the latest data and found that there's just a continued outflow of workers and of companies, and therefore a flip of economic activity. And it's going from the old Rust Belt in the Northeast states down to 6 states that they identified: Florida, Georgia, North and South Carolina, Tennessee, and Texas. And I mean, that comports with a lot of things we've been talking about on our shows for the last year or so. Elon Musk wants to move. He moved a big factory to Austin, Texas. He's talked about moving Tesla's headquarters there. We got a lot of companies setting up in Nashville. A lot of companies are leaving New York City for Miami or other places in Florida. And Jamie Dimon, the CEO of JP Morgan Chase, even said his bank now has more employees in Texas than it does in New York. So, I mean, it's a shift that's been underway for a while, but being, accentuated by what's going on. I just wonder if the heat wave in the Deep South isn't going to change people's mind. They might say maybe they left for the South a little bit too soon, but this trend looks solid.
Yeah, Rick, Ron DeSantis has made it pretty clear he wants to frame the campaign at least around Florida as in the South, but things haven't all been exactly rosy. And I know you've been focusing specifically on homeowners, the insurance industry there. What's been going on?
This is going to get more attention if DeSantis's campaign gets traction. It has to get more attention. There's been a crisis in the market for homeowners insurance in Florida for the last 4 or 5 years. And contrary to what everybody might guess, it really does not have much to do with hurricanes or extreme weather. It has almost everything to do with fraud and litigation in Florida. And just to give you a sense for how bad it is, look at that chart. The top line there is the annual cost of a homeowner's insurance premium in Florida. It's $6,000 a year. That lower line is the nationwide average, just $1,700 per year. So look at how those have diverged since 2019. I mean, there's just been a huge spike in Florida homeowner insurance costs. And it's an interesting story because there were some loopholes in the law there that basically allowed contractors to kind of partner up with law firms and go around to people and say, hey, you could get your roof replaced for free and just say it was caused by some hurricane or some other weather event. The laws in Florida until last year were very permissive. One example that if you sued an insurance company and you won, the insurance company had to pay all your legal fees. So some unscrupulous contractors and lawyers basically got together and created this industry to bilk insurers out of a ton of money. And as a result, something like 15 insurance companies have gone insolvent since 2020. Other insurers don't want to operate in the state. And that's the result is that costs for everybody are going up. Now, they passed some laws to fix this last year, but it's going to take at least a couple of years for this to make any difference at all. And meanwhile, you've got some DeSantis critics in Florida saying, why is he campaigning in Texas and Iowa when our insurance costs are going through the roof and then there's no relief in sight? So I think we're going to hear more about this.
Yeah, no question, a topic that will likely come up with the long road ahead in the campaign. Rick Newman, as always, thank you.
Bye, guys.
Well, coming up, has ChatGPT's run, or at least ChatGPT run its course already? New data suggests some of the buzz is wearing off. Plus, Major League Pickleball names new leadership. So what does this mean for the future of the growing game? Stick around. We go around the horn and check in on today's top stories. That's after the break.
Welcome back to Yahoo Finance Live. We're here with some of the top trending stories of the day. Supermanian Anjali Kamlani here to help us break it all down. And guys, I want to first start off with Meta. It's been a top trending ticker on our site all day. A lot of the gains today have to do with the excitement surrounding tomorrow. And that's all about Instagram's new competitor to Twitter. It's called Threads. Lots of talk about whether or not this is going to be a success, but the timing of it, very interesting, because we've been talking a lot about the trouble that Twitter has been going through ever since Elon Musk took over the helm, took over ownership of the company. So timing, maybe they could use that to their advantage. What exactly this is going to look like and how this is going to appeal to some of their users is the big question.
Yeah, and I think about it in context of, what we've seen happen since Elon took over Twitter, right? We've seen this rush to other sites like Post, like Mastodon, right? Journalists are trying to find a new home, essentially. And you see on your screen, like all the different competitors, essentially. And so none have come out really as strong leaders, I would say, and Twitter still rules. So do they have a chance, considering, Blue Sky is Jack Dorsey's, but do they have a chance considering that they're already an established tech firm and they could really launch in that space?
I mean, I think the timing is just perfect given the fact that everyone's sort of looking for a new alternative to Twitter. It's the rate limits, Elon just being Elon, all kinds of mismanagement possibly there at Twitter. Zuckerberg, the guy never been an idea he didn't like, right? He would copy anyone, and I think this is actually a good time, because look at the kind of the sort of dynamics here. Tons of users on Instagram, easy sign up there. I understand it's a separate app, which is not always the best, but I think it's a kind of a slam dunk right now for people looking for an alternative to Twitter, and Threads seems like it's a pretty good idea from a timing point of view.
Yeah, from a timing point of view, certainly a good idea. Exactly like you said, Zuckerberg a lot of times looks elsewhere for some of his ideas, at least lately. We talk a lot about Reels, how well that has done. That has certainly been mentioned in a number of analyst notes more recently, very similar to what we saw at TikTok, what we do see at TikTok. Certainly that has paid off for Meta. So I think there's a lot of excitement around what this could potentially look like, given the fact that there's so many problems, so many issues at Twitter. We saw a jump of just about 3% today in the stock, but I think really getting it out there, and like you guys said, just in terms of this being a separate app and getting people to download that app and use it and really prove as to why it's valuable, that's going to be critical at this point.
If they don't already run into the exhaustion of people like me who've already been downloading every single other app out there.
and people limiting their time on social media too.
Yeah, that's part of it. I took a look at ChatGPT today. Interesting news out there about a reduction in the traffic to the website. Now, those numbers were interesting to me. Decreased by 9.7% from in June from May, while unique visitors to the site dropped 5.7%. That first number, 9.7, was from mobile traffic. Interesting to think about, of course, the complete craze around it, but where this cut is coming from. I think part of it is school's out, summer's out, summer's in session, so there aren't as many kids using it. But in addition to that, they've also launched their app, which is another part of it. There's new subscriber users. And so I wonder what the impact of that is going to be, and whether or not we'll see those carve-outs kind of make up for that once those numbers start coming in, because all of these moves have been really recent.
I mean, I'm surprised, but not really surprised that the huge run-up in excitement, people wanting to hop on and check it out. What's it like? And then they kind of figure out, I think I've sort of done everything I can on ChatGPT. Right. I think that's sort of the issue, sort of a little dying down of enthusiasm, but maybe it might be something like, I think it's the plugins that might be interesting there. I know some travel sites have now added ChatGPT plugins to allow you to sort of search for different fares and things like that using their enhanced AI.
Sure.
Maybe that's where we're going to see some new applications that people might not think about on their own. How many times can I type in, write me a JavaScript code for tracking Tesla sales? And it's like, okay, but I'm not really a coder anyway, so what am I going to do with that? I tried it today, actually.
Are they impressed? Are you impressed with it?
It worked immediately, but it's, I don't know how to use it. I'm like, how do I plug it into our content management system? But,
we're learning a little bit about a process, I guess, research process on all this. But that also points to one of the big issues with ChatGPT, and that, of course, is the reliability, whether or not you can believe some of the information that it's spitting out. So, of course, when we have heard about some of the pushback with AI adoption and what exactly that's going to look like, that's one of the points that people consistently bring up, and for good reason. When it comes, though, to whether or not we've reached some level of maturity, because I think that's a big question out there, It's going to be pretty clear when September, October, November roll around, right? Because Anj, to your point, people are out of school. A lot of this use case, at least initially in terms of early adopters, were younger people, students that were using it on a daily basis, weekly basis to help with some of their assignments. So if we do see that sort of interaction and that interaction pick up, I think that's going to maybe alleviate some of the fears out there about maybe we have hit some sort of peak in terms of the excitement around ChatGPT. But when you take a look at survey after survey, all of them, nearly all of them, say that we're still in the very, very early innings of adoption, and what exactly the impact on the economy is going to be, we haven't even scratched the surface.
And I've seen that, my inbox is going to be very glad if the craze has worn out, because I can tell you that like simple things like transcription services have been pitched to me as AI and ChatGPT related. So I'm happy about that.
I mean, I saw some wealth manager or one of the financial companies said that the AI is at 80% level of an incoming analyst right now in terms of like capacity. So that's the scary part of where we're going to be with AI, I guess, in the future.
Yeah, and you bring up a good point just in terms of job replacement and what exactly that is going to look like, what jobs are at the most risk, how people who are in college right now or are going to college soon, how they should be thinking about their career, given the fact that some jobs could be replaced. A lot of those jobs are entry-level jobs too.
Yeah. Well, speaking of red hot, white hot trends these days, I'm turning to pickleball. That sport picking up more steam here. Major League Pickleball signing 2 new executives, sort of grow the brand there, turning to, I believe, Julio DiPietro as its new CEO, former finance and media executive, as well as former NFL exec Bruce Popko as their COO. So, really trying to kind of build on that sort of huge momentum here that we're seeing amongst like a certain subset of people, younger, older. And they're talking about how team pickleball franchises could have cost $100,000 a few years ago, now cost $10 million. Like, what?
I mean, no return on investment there.
Yeah, I'm really intrigued by how much this is picking up, considering you haven't seen that kind of return to sports like this, right? The tennis, badminton type thing in quite some time. And so I just think of pickleball as like something you saw, maybe kind of did as a kid, and like it just never went anywhere.
You played it as a kid?
No, I didn't play it as a kid.
I didn't even know it existed. I mean,
I had no idea it existed, but to your point, Anj, I think that's really important because so many people play this casually, right? Just in terms of the fact that there's so many more pickleball courts available today than there were just about a year ago. When you take a look at that astronomical growth, UBS was out with a recent note saying that they're expecting to see a 150% jump in players to just over 22 million by the end of this year. That's compared to 3.5 million in 2019, just 4 years ago. But how much of that is sustainable? And when it comes to Major League Pickleball, do people care about Major League Pickleball? That's the question, just in terms of, there's a difference if you're just going out and killing some time, having some fun, getting fresh air, getting some exercise, and then whether or not you're going to watch people play it on TV. Maybe they will.
I mean, aren't we due for a new sport? Isn't it just innovation?
I was surprised to see that. I guess it is on in certain networks and on YouTube, and it has been rising in viewership. That's surprising to me. I guess people who get involved with it. It's just so shocking to me. I haven't seen a sport like this come on so strong in such a short amount of time, like out of the blue. Usually it's those traditional 4 sports that has been dominating everything, but now it's, I guess my parents want to play now? I have no idea.
Yeah, and it's a fun game. You guys should try it. It is a lot of fun. But we're going to be talking to the new CEO and COO. They're going to be joining us on the program later on in the hour. We're going to talk to them about all these types of issues, the growth that they've seen, whether or not that can continue. Also, just the interest from sponsorships, from media rights, and those types of things in order to grow pickleball Major League and what that would look like.
And the injuries that Josh Schaefer wrote about, right?
That's a whole other thing. That was also from the UBS note. The massive, jump? You're the health reporter.
Yes. I know.
And some of these injuries because of pickleball.
It's a jump in injuries. And also I wonder about the competition that it will create for sponsorships too.
Yeah, exactly. And a time when so many people are pulling back on some of their brand spending or sponsorship spending. All right, guys. Praz, Anj, thanks so much. Like we just said, we're going to be talking a little bit more about pickleball. The new CEO and COO of Major League Pickleball. They're joining us later in the hour. We'll be right back.
The 2023 summer box office seeing a 2% dip compared to last year as it accumulates $1.8 billion since May. But there may still be hope for a bounce back after a few tentpole missteps so far this summer. Here to discuss is Gitesh Pandya, editor of BoxOfficeGuru.com. Gitesh, Indiana Jones was supposed to be the big one that got things going. Wasn't exactly the case.
Right. Well,
what do you make? What do you make of the tepid reaction we have seen so far?
Well, look, just like Harrison Ford, the brand is getting older, and not everybody is there, not all the fans are there. The film opened over the weekend with about $60 million. By comparison, the last Indiana Jones film did over $100 million opening weekend. So the gross was down 40%, and that was 15 years ago. So if you look at ticket prices today, about 60% smaller audience came out. That's less than half the number of people came out for this new film. Now, it's a better film. Kingdom of the Crystal Skull from 2018 was not that good of a film. I think that hurt the brand a bit. Also, Steven Spielberg did not direct this new movie. I think that hurt a little bit as well with the hardcore fans. And also, they had a world premiere at the Cannes Film Festival. Very risky move to do this and show it to very, very snooty media a month before the release of the film. Mixed reviews, tepid reviews, so that really put a damper on things as well. It did do pretty well on Monday and Tuesday, so over the 5 days going into today's business, it's up at about $84 million, but definitely less than what was hoped for such an expensive movie.
Well, Gitesh, you point to the fact that this is a very old franchise, more than 40 years old. Can we conclude, or maybe this is just a one-off type of scenario, that the legacy sequels, which we have seen become more and more popular, is that a bit overdone at this point?
I think it really depends on how the film is made and how well it is. Remember, just 1 year ago, we had a Top Gun Maverick film. First time since 1986. People said, well, who wants this? And it was a mega blockbuster here and around the world. So it really depends on what the film is, how it's made. And this one with Indiana Jones, I thought it was a good film overall, but not a great film.
Gitesh, I'm in the camp that I was surprised to see how well Top Gun did last year. But to your point, maybe it is just all about the content. If you think about what we have seen so far in terms of performance at the box office, does this say anything about just enthusiasm around the theaters, or is it really just about the content and the fact that people just aren't as excited about what's come out so far?
Well, it's really about reducing risk, and that's what a lot of businesses are about, and the movie box office is no different. If you look at the highest grossing films, they tend to be brands, sequels, movies where the audience knows I'm paying the record amount of money per ticket. I want to make sure I'm getting something good and entertaining for my money. So that's why you see all these big franchise movies and different kinds of IP make the most money, and original films are having a much harder time because also the habits have changed over the pandemic. People are streaming more, people are watching things at home more, and so you're seeing this sort of dichotomy where original content thrives at home and the sequels and the brands thrive at the box office. And we have to see as the year goes forward, can major original films still pull in a large box office?
Gitesh, what do you think the remainder of the summer is going to look like? We do have Oppenheimer, which is one of the most highly anticipated films. Barbie, we've been talking so much about that. Mission Impossible, pointing to that legacy side of it. Are one of those going to be a huge hit?
Well, I think July is going to be very good. I think the problem with June is that you had too many big films squished up together right on top of each other. In July and August, we'll see some more space. And so these movies have more breathing room. So you have opening this weekend, Joyride is an R-rated comedy. I think that might do pretty well. It's a smaller film. But then a week after that, you have Mission Impossible, Dead Reckoning Part 1. That tells you there's going to be a Part 2 next year. But I've seen Mission Impossible. It's a terrific film. It's a great summer action movie. It just hit on Rotten Tomatoes today at about 98%. So all the critics are loving it. And the last Mission Impossible movie was the highest grossing one yet, almost 800 million worldwide. So this is going to keep it going. People still like this brand, this franchise. That's going to be really hitting it out of the park. However, for the rest of the summer, it's going to be a little bit of crickets because you don't have too many big hits, except of course for one weekend after Mission Impossible, you've got Barbie, which is really red hot. I think it's going to overperform, do very well here and around the world. And also Oppenheimer will do less business, but still strong male skewing business with that sort of Christopher Nolan audience. So room for both of them to survive.
I mean, Barbie's marketing budget alone has been incredible to watch. Gitesh, you mentioned all the blockbusters that we're expecting this summer, but any sleeper hits that you've got your eye on?
Well, for the summer, I think it's going to be very much about the brands. I mean, Barbie, I wouldn't call it a sleeper hit, but everyone I'm talking to is really excited about it. I think it's going to play broader than people think, and so the grosses will be do very well. But as far as the rest of the year, I think we do have some films coming up which will kind of break out a bit. So one film coming up, we have to wait until October. This is the new Martin Scorsese film. Now, he's back with a new film. It did premiere at Cannes. Now, the reviews, unlike with Indiana Jones, out of Cannes, the reviews were fantastic. I think it's something like 97% on Rotten Tomatoes. It's doing very well. The trailer just came out today, and it's got an interesting release. Paramount Pictures will release it in theaters the traditional way, and because it's such a big budget film, you've got Apple TV Plus involved, and they've got deep pockets. They're the streaming partner. They will take it onto streaming soon after the theatrical release, so everyone can see it. But it's based on the book. You've got Leonardo DiCaprio, you've got Robert De Niro. Scorsese has done multiple films with both of these actors, and so the first time he's bringing them two together under the same roof. I think that gets a lot of excitement. Oscar buzz will be there. I'm assuming it's a good film. I haven't seen it yet, but if it has good word of mouth, this could be one of the only original movies that can be a big box office hit this coming fall.
Yeah, really high expectations running on that one. Gidesh Pandya with Box Office Guru, editor there. Thanks so much for joining us today.
Thank you.
Women are still dramatically underrepresented in executive positions across the country. I spoke with Condoleezza Rice, former U.S. Secretary of State, and also Allison Felix, 11-time Olympic medalist at the KPMG Women's Leadership Summit last month, and discussed what leaders and their companies can do to better improve those numbers. Let's take a listen. Secretary, let me start with you. Just give us your sense of why we are where we are today in terms of the data the most recent data from McKinsey showing that women account for just about a quarter of C-suite positions, yet they make up about half of entry-level positions. Why haven't we seen more progress up until this point?
Well, the hopeful thing is that we've gotten to 25%. That is something to celebrate because we weren't there just a few years ago. And you always have to look at the pool. So the fact that we have 50% of women in, quote, entry-level positions, the real goal now is just to make sure that they progress into those positions of the C-suite. You can't sort of create top-level management out of thin air. You have to nurture it and bring it along. And I think efforts like KPMG here to make sure that women who are maybe even on the cusp of making it into the C-suite have the tools and the mentorship and the networks to make that next step.
Speaking of the tools and the mentorship here, Allison, from your perspective in sports, the biggest barriers that are facing females in terms of the equality when it comes to pay, the equality when it comes to treatment, what do you think are the biggest challenges that women are still facing to this point?
Yeah, I think visibility is still a huge issue. We've made some movement on pay equity, but it's still an issue. And so we're still working to be represented fully. Maternal protections, something that I'm very familiar with is a huge thing. The culture of sports and women not having to choose between motherhood and the sport that they love. So I think there's some really good momentum. I think a lot of positive things are happening, but there are some real challenges.
And Secretary, from your time with sports to government to the private sector, what do you think is that common theme just in terms of why we should be so encouraged about the future advancement of females in the workplace?
Well, we should be encouraged because we had too many firsts, meaning that not enough women had made it into those positions. And now we're starting to talk about, we've had 3 female secretaries of state. That's something really that we should celebrate. But we can't rest on our laurels because it's still hard, given what women face in terms of you walk into the room and somebody looks at you like you're in the wrong meeting. You have to be strong enough to say, no, I'm in the right meeting, and pretty soon you're going to know that. And that takes mentorship, and that takes having people help you along. I was really fortunate. I had great mentors. I will tell you something. We have this conceit that your mentors have to look like you. Well, if I'd been waiting for a Black female Soviet specialist role model, I'd still be waiting. And so sometimes you might have to, or you might find that your mentors don't look like you. As long as they advocate for you, as long as they see things in you that you might not even see in yourself, accept that mentorship and in a sense, earn it.
Who were your biggest mentors?
Oh, my biggest mentors by far were Dr. Joseph Corbell. He was Madeleine Albright's father, by the way. He was the professor whose course I took to get me from a failed piano major to somebody interested in international politics. And then a man named Brent Scowcroft, who would be National Security Advisor to George H.W. Bush, who really took an interest in my career. And he was the one who first brought me to Washington.
Allison, you have also seen your fair share of success as the most decorated Olympian in the track and field in history. Who have you looked up to? Who has helped you get to where you are today sitting in this position?
Yeah, Jackie Joyner-Hersey has been a huge inspiration to me and a mentor who has really cared about my life, and invested in me. And that's really been huge. As you said, mentorship is so amazing. And especially as I transition from a competitive athlete into the business world, having someone to really navigate you through that space has been huge.
And speaking of transitioning here into the business world, you're the co-founder, I should say, of SAISH. How are you cultivating that culture that is necessary in order to train the next generation of female leaders?
Yeah, I think having a really diverse team, we're trying to do something that hasn't really been done, making shoes specifically to fit the form of the female foot when other companies aren't doing that. And so our mission aligns us. And so bringing everybody together with that core that we believe that women deserve better in every single aspect, and really fostering that environment.
Let's go back to what we touched on briefly, and that was pay and pay equality, or the lack thereof. And Secretary, as a co-owner of the Denver Broncos, you have a front row seat to what the National Football League is doing, but I know you closely follow professional sports. When do you think women will reach their equal pay day? We have seen some progress when it comes to what the women's national soccer team was able to accomplish, but we still got a ways to go.
Well, the remarkable thing for me is that the women's national soccer team even had to make that fight. I mean, they were by far the more accomplished, the ones that everyone wanted to watch. They'd won the World Cup. They put soccer on the map. Why were they even having to fight for equal pay? And I'm glad that they finally did, but it just says something. Now, on the other hand, I was on a panel a couple of years ago with Billie Jean King. She fought for equal pay in tennis decades ago, and women have been paid equally in tennis. And so it says to me that raising the issue, it says to me that making the case, I do believe that people want to see equality. They don't want to see people, the population doesn't want to see people disadvantaged. So when you learn that the women's soccer team was not receiving equal pay, pretty soon there's a lot of pressure to give them equal pay.
Allison, what has the conversation been like among your peers, athletes who are pushing for their moment and for their right to be paid what they should be paid?
I think we're seeing just the momentum of people speaking out. Like Dr. Ice said, there's power in that, and there's power in the collective. And I think athletes aren't really scared any longer to stay in their lane. They know that they can talk about issues that they're passionate about, and pay being one of those.
Secretary, when we talk about the advancement here of women, we're still waiting for the first female president. Now, we do have the first female vice president, Nikki Haley, also among those who are running for the GOP nomination. How confident are you that we will see a female president soon, and what is it going to take in order to see one?
Oh, I think we will have a female president. I think we again, when you look at where do we select our presidents from, with one notable exception, usually it's people who've been governors or senators. And so when you see the number of women governors, the number of women senators, Senator Clinton, when she ran, now you mentioned former Governor Nikki Haley, who was also UN ambassador. So are there any questions about her foreign policy chops? No. And so I think you'll start to see, as people move into these positions that are the places from which we take our presidents, that you'll start, eventually we'll get to a female president.
So what do you ultimately hope to see change for the next generation of females when it comes to sports, business, even through in government? What is the one thing that you would like to see change going forward?
When I think about my daughter and, the aspirations that she'll have, I hope that she doesn't have any limitations. I hope that she can go after what she wants, that she doesn't think twice because she is a girl, because she is a little Black girl, that those aren't barriers for her. And so that's my hope. And that's why I think we all do so much work and are so dedicated to really making this world better.
And Secretary Rice, similar question to you. What do you hope is the next wave of change for women who are growing up across the country?
or around the world too. Yes, well, I hope that here in the United States and in the developed world, I would agree with Allison that we aren't even sitting here in a few years even asking the question. And I see in younger women expectations that I really never had, and I'm delighted to see that. But sometimes I think we almost talk about the barriers as if they're impenetrable, and they're not. And so I say to young women all the time, it's there for you. Go get it. And I hope we can get there. But, we have to remember, and I am a specialist in international politics, there are a lot of women in the world who are just trying to survive. And as we fight for women's rights here in the United States, I hope we don't forget how hard it is if you are living in a remote village in Cameroon, or if you are in a Guatemalan village trying to fight off gangs for your families. I sometimes think we get very focused on our problems and they seem immense. They're really not immense when you think about some of the challenges that women around the world have. Yeah.
Our thanks to Condoleezza Rice and Allison Felix for that discussion and also for their time. All right, well, coming up, Major League Pickleball has announced 2 new big players when it comes to its leadership team, the CEO and the COO of Major League Pickleball. They both join us next. Major League Pickleball has announced 2 new big players when it comes to its leadership team as it looks to capitalize on the sport's fast-growing popularity. The number of people playing pickleball surging a staggering 86% from just a year ago. Giulio Di Pietro has been appointed as CEO, Bruce Popko as COO. They both joined us now. Giulio and Bruce, great to see you both. Congratulations on the new positions. Giulio, let me start with you and start with that surge that we've seen in popularity. What gives you the confidence that that type of momentum can continue?
I think the clearest metric that we have is the avidity rate, which is kind of a fancy word for saying that basically when people start playing, they keep playing. And you know, I don't know anyone who has started playing that doesn't still play, and you know, play. The more they play, the more they want to play. You know, my father's 80 years old, and a week after his 80th birthday, I took him to play for the first time. And I checked back in with him about 3 months later, and I speak to him every week, but I hadn't asked him about pickleball, funny enough. And he said, yeah, I play 5 days a week now, 2 hours a day. Again, 80 years old, just picked it up, and he's playing 10 hours a week. So that's kind of when I realized this is not a fad, this is a phenomenon.
Bruce, it's one thing to play, it's another to watch a competitive league. Last I checked, there's 36 million people who've played pickleball. How do you convert those 36 million into MLP followers?
I think the biggest thing for us is to go where they want to be, to present our product, to present our players in the spaces that they're most comfortable, whether that end up being social media, on broadcast during events, or as part of community events as the 24 teams begin to sort of lay their claim in their local markets and really begin to develop those local fan bases.
And Julia, what's also critical is developing those sponsorship relationships, those brand relationships that we know is so important to the growth of a league. What does that strategy or what does that opportunity look like for the league?
Well, we already have a number of great sponsors. I mean, Margaritaville is our title sponsor this year. Toyota is a big sponsor. So just the conversations we're having this year relative to last year, it's night and day, and we continue that trajectory to continue. We expect that trajectory to continue.
Bruce, as a former executive, in the NFL with the Buffalo Bills, you obviously have good knowledge of getting more eyes on a sport. And you just talked about the distribution, trying to reach the players where they are, the viewers where they are. You've already got a number of partnerships in place, as I understand, TV partnerships with the likes of ESPN. But what are you thinking about in terms of other distribution? Is this the kind of sport that you think can gain more traction through social media? Is it a TV sport? Is it a streaming sport? How do you look at that part?
I think it's all the above. And I think that actually it also begins to be not only a domestic product, but an international product. We literally had a couple of conversations today about where do we go next in terms of our media rights. I won't even say television rights anymore, because obviously there's so many vehicles to be delivering on them. So yeah, I think every single one of them is under consideration. We've had really strong relationships with some of the biggies, in sports and entertainment so far. But there are so many other players that are out there, and we need to figure out which ones of those resonate most with our fans. Are, like I said before, where are they? Because we want to make sure that our product, as we take them from participants into fans, is most easily and readily accessible.
Bruce, what does that international opportunity look like? I know you're saying that you're still trying to figure out exactly where those players are, but the popularity that we're also seeing outside of the United States, what does that potentially do here for your league?
Yeah, it does a lot for us. And it's interesting that we live in a racket sport environment where, we watch where there is strength in table tennis and badminton and padel and other sports like that. And we know that Major League Pickleball is the greatest presentation of pickleball, plain and simple. But for us, we say, okay, there are these derivative or racket sports that are part of the larger universe for us. Let's go to those places where there is an embedded population and popularity with those and bring the sport to them for, so like Julio was saying, experimentation, even with, an older demographic. And then what does that translate into in terms of fandom?
Julio, still very early days in the sport, but I wonder what markers you have set for yourself as you set out on this journey to really expand Major League Pickleball. And is there a league that you see out there that could provide potentially a template for MLP to follow?
Sure, that's a great question. I think one of the ones that we're looking to, which was probably analogous in a number of ways, is Major League Soccer. We've adopted certain elements of the structure of MLS when it started. And a lot of people said soccer would never catch on as a spectator sport in the US, and all the other legacy sports were too entrenched. And obviously they've shown tremendous growth. And I think, we have a similar sort of metrics in terms of pickleball, like soccer was 20 years ago, is a phenomenal participatory sport. So as you said, there was something like 30 million people played in the US just last year. If we can, our Bruce and my biggest opportunity, I'd say challenge, but also opportunity, is to convert some of those players who love the sport, who love playing, into fans. And we think that our platform, our format of Major League Pickleball with its co-ed nature, we have 24 team franchises already in cities across the country. We're giving people the content and the geography and the team format, giving them something to root for. I think we're going to find success because of that.
Well, certainly it has been incredible to watch the soaring popularity of the sport of pickleball. We look forward to tracking what the future holds for the league. Our thanks to Major League Pickleball COO Bruce Popko and CEO Giulio Di Pietro.
Thanks, guys.
Well, it is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Well, China is restricting the exports of metals critical to manufacturing semiconductors. The new rules specifically target gallium and germanium. It comes months after the U.S. imposed sweeping restrictions, all but banning shipments of advanced chips to China. And of course, it comes as Treasury Secretary Janet Yellen prepares to visit Beijing tomorrow.
And the Federal Reserve showing some signs of division. The minutes from the latest Fed meeting showing that despite the unanimous decision to pause rate hikes, some FOMC members wanted to raise rates last month. They said that the economy was stronger than anticipated, and there were few clear signs that inflation was on track to go back down to 2% over time.
And signs of strength for the auto sector after struggling with pandemic delays and supply shortages. New vehicle sales rising in the second quarter with General Motors leading the way. GM reporting sales jumped nearly 19% from a year ago. Toyota sales jumped 7%, while Stellantis posted a sales increase of 6%. And for Tesla, price cuts helped the company beat estimates for second quarter delivery.
All right, well, that does it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.